This one is nestled between a whole bunch of multi-million-dollar estates. In fact, if I zoom around the area and I showed you, this would be like the horse farms, the rolling hills, anything beautiful that you think about Kentucky and kind of the upper Midwest or the Midwest. This is what this property is. And it's nestled between all of these. So I won't go through this whole video right now, but I just want to kind of show you exterior view. You've got these buildings, these beautiful brick buildings nestled between $1 million estates in this part of the country. It's truly a gift from God. I'll come to that a little bit later. Numerically, the way that this property works, it's presented by some really cool people. I promise we'll get into who we are and all that kind of stuff in a minute, but I want to numerically just talk about it. Right now, it's under rented. The seller likes their occupancy. They like being 100% occupied. So they're keeping the rent super low. They're at $1.19 per square foot. We're going to come in and raise rents. That's what the building needs to have done. We're going to raise them to market. Market's at $1.57. We have a lot of extra room to grow on this property without a lot of work needing to be done to it. And then numerically on this thing, it's looking to be between a 16 and an 18% internal rate of return. We're looking for accredited investor partners. We'll talk about what that means a little bit later, but all in all, this is the best deal of 2024. And I know that, and those of you that have been with us for a while, you know that we have not published a multifamily deal yet this year. It's not because we're not making offers. We are making a lot of offers, but we're being very patient. We're waiting for the right deal, and this is the right deal. So we'll get into some of the specifics on this a little bit later, but that's kind of the high level, Steve.
Okay. Do we want to go through like what are expected returns on this? What is the waterfall split? What is our timeline?
Yeah. So we estimate this could go anywhere between 3 and 7 years. We don't want it to overpromise anybody, so we like to kind of give that average of 5-year mark. But the property is not very complicated. We're coming in and we're updating units. You can see just from couple of these visuals, they're not bad. We just need to go in and update them as tenants turn over. So when a lease expires, we come in, do the updates, and then we're able to bring it back to market and get a higher rent rate out of it, closer to that $1.57 per square foot. And for an investor coming into it, if you invest $100,000, which is our minimum, then you can expect to get a couple of things. Number one, we're aiming at a 6% preferred return. What that means is that we take 100% of the cash flow. Year number one, we give it to you. You get all of it right out of the gate, year number one. And then what we're going to do to create the rest of the profit, that mark up to that 18% line, is we're going to go in and increase the value of the property. We do that by increasing rents. It lifts the value of the property. And then somewhere between 3 and 7 years later, we're going to look for an exit. An exit means, easiest way to describe it is to sell it. If we sell it, we take in all the profit, we give you back your money, we make sure you got your preferred return, and then we're going to exit on it. And that's where we think that we can get our investors up to 18% on this property. So that's kind of what it looks like. If you have a larger dollar amount that you're able to invest, we do have a couple of tiers. They're fine print on the screen, but we'll talk about these in detail later. But those of you that are able to come in with a $500K investment, we have better preferred return, meaning instead of a 6%, it bumps to an 8%. And then instead of a 70-30 split, it jumps to a 75-25 split in favor of the investors. And then for those of you that are able to do $1 million or more, we have an even more favorable preferred return of 10%. And then the split also goes up to an 80-20 in favor of the investor. So if any of those sound interesting, I'd encourage you to book a 15-minute phone call with us. We'll go through all the details with you. We'll give you this document that I've got on the screen right now. We'll let you see anything that you want to see on it. And then we'll cover more of it on this call as well.
Awesome. So if you would like to come into this deal with us, I am grabbing the link right now. Sue actually got it. She beat me into the chat with it. You can click that link. That will get you on my calendar or on Sue's calendar. We'd be happy to walk you through the deal, any of the particulars around the preferred return, the waterfall, and the total investment return that you'll get at the end. We're happy to answer any questions and share the OM with you as well. Now we're going to take a second and we're going to move into how we found this deal. So one of the things that we talk about quite a bit at Home Invest when we teach multifamily is we talk about how it is a long lead gen process. You usually start, you develop a relationship, and it takes a couple years to mature before the person is ready to invest with you, ready to give you the property, right? Ready to list and move forward. So we want to talk about that. A lot of people have asked, like, how do you do that process? So we want to bring Mike up. If we can highlight Mike. Mike is our partner in this. Mike Fritz, let's get you up here. Good morning, sir. How are you? You're muted, just so you know. Oh, I got to unmute you, huh?
Yeah.
Oh. Nope.
Try that
There
one more
we
time.
go.
There you go.
I got it. There I am. I was going to say I didn't have the steering wheel. Thank you, Mr. Werner. I appreciate it. Yeah, great to be with you all this morning. Yeah, this was a fun one. So the first time I made an offer on this building was 2021. And the second time I made an offer on this building was 2022. And the third time I made an offer on this building was 2023. And this year we finally got it. I've been tracking this property for about 4 years with this same seller. He's had it for 4 years and been continually the rent growth plan. And finally this year, he's kind of ready to stop the CapEx plan and hand that baton off to somebody else. And he wanted a price a little bit higher than we were willing to pay. And I said, the only way we'll do that is you got to seller finance this deal, and you got to seller finance it below what we can get on a traditional market loan. Going to the market right now, we're probably going to get high fives, just below 6. That's a hard rate to get right now, unless you have some chops in the market. And Nate and I and Steve have been doing deals for a long time, and so we were able to get some of those loans. But we went to the seller and we're like, hey, you got to give us that 4%. So he came back and he agreed to do a 4% loan, lowering, of course, our loan payment, meaning we could pay a little bit more for the property. So when you negotiate a property, you have price, you have terms. Terms sometimes will make you more money than price if the terms are in your favor. And in this building, the terms were in our favor. Nate made a comment right there of taking rent from $7.45 or $1.19 a square foot to $1.54 a square foot. I want to tell you why we targeted this property. That means that the property today, if the units were at what just people are getting in the area, market rent, it would be worth 2.2 million more than we bought it for. So just if they were at market, not if in 5 years it grew to where it will go, just at market, it's 2.2 million under rented. So that's a really good thing. And the other reason we targeted this property, it's outside of Lexington, which is an incredibly powerful market, but it's in a little town called Georgetown that is exploding because the massive Toyota plant is there. And there's a lot of other manufacturing. I actually personally own a manufacturing company about 15 minutes from this specific building. And we leverage that manufacturing area as well. So there's a lot of great jobs. So that's why for a 1-bedroom apartment, you can get over $1,000 in Lexington, Kentucky, or just outside of it. So that's why these rents are that way. So that's why we went after it. And that was the journey. And we as a team have been plugging this one for a while, or targeting it for a while.
Mike, I mean, that's the conversation that we have with a lot of people is like, if you want to find off-market deals that are not through brokers specifically or not listed on LoopNet or Crexi, you've got to build relationships. How did you start the relationship here 4 years ago?
Well, so I went to all those sites. I went to Crexi, and I went to LoopNet, and I went to, what's the other one? The big CoStar. I went to these, and I was on these, and I didn't even have a CoStar account at the time. And I just saw who was targeting properties who was moving multifamily, who's moving multifamily real estate in the area. And I picked up my phone. I started calling everybody that was moving multifamily. And now we are the #1 buyer from the #1 seller of multifamily in the state of Kentucky. So we are the first phone call that when the #1 seller of multifamily real estate in the state of Kentucky gets a deal, especially in 100 miles around Lexington, we're the first phone call, and that's taken about 6 years to build that relationship.
6 years to build a relationship. I just want people to hear that. Like when you see some of these other people putting deals out into the marketplace, that the numbers don't work all that well, it's because they're going after very short-term, instant deals. We put a lot of time and energy into building relationships and getting properties that come to us off market when the seller is ready, which leads to us usually having economics and numbers in the deal that work a whole lot better. We're going to talk a little bit more in a second about why we picked this area. That's another question that goes on. Nate, I'm going to kind of throw the ball back to you, and Mike, you can chime in on this as well. We got this owner financed at 4%. That right there is what makes the deal work. We were able to strike a bargain with the seller that made everybody happy. It makes us great returns. It makes our investors great returns. It also makes sure that we have a property that performs in the way that we need it to. Nate and I are usually very, very conservative. Mike, I know you are as well. We want to make sure that we can perform. Can we just walk through kind of why this property and why the financing and the capital stack is different than what you might see out there in the marketplace right now?
Pretty easy to do. So I'm just going to pull up a spreadsheet. I know my spreadsheet fans out here. Who are you? Hey, you guys love this and you'll geek out with me. But those of you that don't like spreadsheets, I promise I will not put you to sleep. But when you bring in debt into the equation and you're starting to assess the property, the number one decision maker on a property really should be your debt right now, because we all know what's happened over the last 2 years. Interest rates rose faster in the last 2 years than they've ever risen in US history. So debt has to drive decisions. And so when you get into a property, one of the biggest factors is always debt. And this particular one, our cap rate without the debt is solid. But then when you add the debt on top, our debt is less than the cap rate. You can see here on the spreadsheet here, we can get an average of 6.5% of capitalization rate. That's after year number one, after we start to lift the rents on it. But our debt is less than that. The entire time that we're in this deal, our debt payments are less than the cap rate. And that's really the magic trigger. When you're looking at deals, if you start to see the debt costs more than the property's actually bringing in for income, that's a troubling sign. For us, this one is smooth sailing right out of the gates. We actually are in a position where we can pay out distributions on year number one. And I know that's become a rarity. A lot of times on deals, because I look at deals all the time, I invest in other people's deals sometimes too. And when I'm looking at deals, a lot of times people are saying, you don't get distributions until year 2 or year 3. That's not the case for this property. We're able to, as long as God blesses us and everything goes according to plan, we're able to pay out distributions right from the get-go on year number one because the debt is so cheap on the property.
And to Nate's point, if you noticed on that sheet, it says we're buying it at a 6.5 cap or capitalization rate. That means we have what's called a 2.5 point delta from debt, meaning 4% interest rate, 6.5% capitalization rate. Having a 2.5 point difference from your debt to your cap rate in this market currently is unheard of. That's why Steve said it's the best deal we've seen in close to a year, maybe longer than that. Because I haven't seen a 2.5 point spread, but from cap rate to debt rate in a long time, a very long time. Like probably since COVID hit, I have not seen that kind of spread on cap rate to debt rate. And so, and year one, we also we got 2 years of interest only, meaning we get to feel the full weight of that. We're only paying interest, not principal. That means for 2 years, we're going to experience more cash flow till we get those rents up. And so when the principal kicks in, it's not like it's going to hit our distributions. We're not going to be able to make distributions kind of thing. So that 2.5 point delta, that's kind of like your insurance of cash flow. That's your insurance against a property, right? Right now, that's why when Nate said debt makes decisions right now, that's why. And so just to point that out, that spread right there, that's a powerful spread right now. In fact, I haven't seen it since COVID. So anyway, that's why we're pretty pumped about this deal.
Nate, if we can just talk for a second about paying out distributions like right away. How often do we pay distributions, and how is this property going to be able to cash flow? I know Mike just kind of touched on it, but if we can just share that with people. And again, if you would like to book a call and talk with myself or Sue about investing in this property, right now we are verbally committed for the entire amount, but we always take people in backup. This is a great deal. It filled up very quickly for us. If you'd like to book a call, Sue can put the link in the chat. You can book a call with either of us, but let's go through, Nate, how do we pay out distributions right away?
Yeah, there's a couple things to that. Number one, we are incredibly tax efficient. So I'm going to talk about how we specifically code that to make it a very tax-friendly move for you guys as investors. And then number two, how are we able to do it right out of the gates? Now, most deals that are out there, they'll say, hey, we'll pay distributions year number 2. First, we got to buy it and increase rents. We're in a position on this one where we're projecting that we'll pay right out of the gates. We'll take all of the cash flow essentially that's coming in year number 1, and you as an investor partner, you get that cash flow. And that's year number 1, that's what we're planning to do. We'll continue to raise rates, and that's where we start to get paid as managers on the deal as well. So it's a 6% preferred return for a 100K investment. For those that are doing more than 100K, if you're doing 500K or $1 million, I'm going to put these tiers up on the screen really quick. The preferred returns start to go up, and they look like this. So tier number 1, it's a 6% preferred return on 100K. If you do 500K or more, it's an 8% preferred return. And then tier number 3, it's $1 million or more, it's a 10% preferred return. Now, the property's paying out in cash flow right now 6%. It's not paying out 10% yet. We need to go in and do our job, which is to raise rents, renovate units, things like that. So what that means is that you get the preferred return. Even if you do $1 million investment, you get the 6% year number 1. And then as soon as the property starts to climb to the level where we can pay out 10%, you'll get that. But for sure, for folks that do tier 2 or tier 3, before we get paid as managers on this deal, you get to collect that money. That's why it's called a preferred return. You get the preference over us as managers on the deal. So does that answer your questions?
Yeah, if you can leave that up for just a second, Nate. One of the things I want to share, if you're looking at that and you're thinking, well, I was going to come in for 100 or 200, but I'd really like that extra preferred return and the extra piece on the equity split. If you bring in somebody with you, you do not need to combine into a single LLC, but if you bring somebody in that you refer them to us and they invest alongside of you, as long as the total amount is 500K, we will honor that for you. The same goes for the $1 million. So if you have somebody that you think would like a return like this, you can bring them in with you. Basically, we will put the money all in a bracket and we will honor that for you guys. That's a way you can get a much stronger return. This is also open. We're kind of tight on the deadline, but if you're looking for a IRA rollover or a 401k rollover into this property, we can probably make that happen, but we've got to get started on that right away. This is a great way to grow your retirement account. Last piece I want to touch on here, Nate, before we move on. What kind of tax incentives do people have with this?
Yeah, you know what I'd love to do, Steve, is maybe we can bring on Chris for a second. And Chris is one of our partners on this deal, and I'll take a second to talk about team, and then we'll talk about tax benefits. One of the main reasons that we as partners on these come together to buy these is for the tax benefits. If you're not familiar with some of the tax benefits of real estate investing, welcome to the greatest gift that I feel God left us on tax defense. I'm not kidding about that either. I don't know of a better tax defense than real estate, because the IRS recognizes that we're stimulating the economy. We're creating jobs. Like, there's a lot of good that comes when we put money into real estate. And there's something called accelerated depreciation that we get. Chris, there he is. Hey, Chris, how you doing, man? Those of you guys that haven't met Chris, you guys have met Mike before, you met Steve, you met me, you met Sue. If you haven't met Chris before, Chris has partnered with us on deals now for the last year. Amazing businessman. If you've ever been on a cruise ship and you've turned on the TV and you got channels, you can thank this man. The technology that gets to the satellites and gets to the cruise ship is brought to you by Chris Lavin. So he's very well versed in business. So Chris, talk to us about tax breaks, tax incentives. Oh, you got muted. Let's see if we can get you unmuted.
He's unmuted. Your mic is just not set up.
Maybe your mic's not, yeah.
Okay. While Chris works on that, I'll fill in the
There we go. Is that better?
Yeah, there
There
it is.
we go.
Sorry about that, gentlemen. So yeah, as Nate was talking, accelerated depreciation and bonus depreciation is the gift from God. And the way that works is there's a certain tax code that allows us to take the 27.5 year of depreciation and shorten that length of time so that we can take all of that depreciation over the course of 5 or 7 years, depending on the actual item. And we get to move that all and take it in the first year. So what that means is, as we acquire these properties, you can expect to see a 30 to 40% tax break, right, or quote unquote, as Nate uses, tax credit of, you know, $300,000 to $400,000 depending on the $1 million. And on 100,000, that would obviously be $30,000 to $40,000 right from the very beginning. This property is just absolutely prime for that. The second thing that this property is absolute gift with is a 1031 exchange. So if you're interested in a 1031 exchange and you have that situation, this is ideal. Many banks and Fannie Mae and Freddie just don't want anything to do with the paperwork and the legalities of 1031 exchanges. But because Mike was so great at getting this owner finance, this leaves us wide open to make that happen for anybody that wants to take advantage of that. So check the box, check the box, check the box. This property is just absolutely primed for a great transition, great tax breaks, and to get you great benefits. The other thing I'd like to talk about, if you don't mind, is the actual market of Georgetown, Kentucky. I've had the privilege of speaking to several owners of multifamily properties. I spoke to a young man yesterday who owns 40 duplexes in the area, and has a small 12-unit multifamily. And just kind of getting the feeling of the market and what's going on there with him. I'm sorry, it wasn't yesterday, it was the day before. And the sentiment has just, it's just, you know, he waved the magic wand, and what's going on is Toyota, right? So Toyota is the biggest employer there. Currently, they have 9,300 jobs. There's 9,300 people employed at Toyota. And currently, every one of his properties is at 100% leased, just like this property is. The difference is he's getting above market rents. So because there's a lack of housing in the area, he's getting above market rents, and he is at 100% capacity with a waiting list. Why is that? Well, Toyota, 9,300 jobs, just announced in 2024 that they're investing $1.3 million in an all-new 3-row battery electric SUV for the U.S. market and production to start in 2025. So there's already a shortage there. They're bringing in another 93 to 9,500 jobs. All of those families are coming in there, and that's going to drive rent prices through the roof. So now with 30% below market, at market being at 157, the market rents are going to increase again because of supply and demand. So this is an ideal opportunity for both income growth, multiplying the NOI to get us to multiplying the value of the property for a great exit strategy, as well as all the tax benefits that were spoken of. So this is, Nate said it from the very beginning, this is one of the best deals I've seen in a long, long time. And we've had some killer properties in Kentucky. You know, Nate was talking about, you know, paying out in the first quarter of every one of the deals that we do. We did another property in Lexington, Kentucky recently. Our investors were blown away by the fact that we were able to give them their 6% return in the first quarter. We acquired it in December. And April 15th, they were receiving their first quarterly distribution. And a lot of those people are right back in this deal too, because we deliver on what we say. That's all I got. Thanks.
Awesome.
You know,
Chris, you
Chris,
touched.
that's a really good point about the area and because I own that manufacturing company up the road. All those estates you just showed, Nate, that $1 million estates, there's one road that goes from Georgetown over to where I own manufacturing. That's some of the most beautiful land, but it's all owned by horse farmers, so nobody can develop it. So what it does is it creates a housing squeeze. So there's not even anywhere to build because all the horse farmers control the land around there. So when you do have a multifamily property, there's one right next to ours. It's also 100% occupied. It's just the track of this, and that's, I think, 130 units might be right across the street. And so it's but again, it continues to drive. There's just nowhere to go with housing, and so they're gonna have to figure something out because they need more housing. But that's really good for us on this property. It's a good point, Chris.
Yeah, that is the point that I wanted to bring up. We actually started investing in Lexington a couple of years ago because we saw the potential. We saw both the fact that they can't really build much when it comes to multifamily. They're going to have to increase density somehow, which pushes rents up faster. The other thing, Nate, I'm going to throw you the ball on this one. If you want to talk a little bit about why Kentucky is a great state to invest in. One of the questions we get all the time when people want to consult with us on how to get into multifamily is where should they invest? What states should they pick? What cities should they pick? So we're going to show you why Georgetown fits and is in, like, recently apartments.com rated Louisville, Lexington, and Kentucky in general in the top. Let's show why.
Yeah, this is that article, apartments.com. This is usually you'd hear about Florida and Texas and all these Sunbelt markets hitting the top of this list. Kentucky is there. Kentucky is #1 market in the country right now. Why on earth is that? Well, it's one of those states, a lot of people used to call it a flyover state, but it's nothing but that. The last 10 years, it has been in the top 10 business-friendly states in the country. The governor, Andy Beshear, he's on the short list right now for a vice president nomination. Andy Beshear's done a good job. He really has. He's brought both sides of the aisle together to bring in businesses. When you see people like Toyota coming in and dropping $1.3 billion to expand their battery plant operation, it's because both sides of the aisles are championing business development. Business development brings jobs. Jobs brings rent. If you don't have job growth, if you don't have wages growing and people with income, you're not going to have the rent growth that you want in properties. So for us, what we're seeing in Kentucky right now is consistent growth because of all the jobs that keep pouring into this place. So Georgetown, if you're looking for it on a map, you literally, we'll zoom out a little bit. Louisville is the capital, the big city on the left. About an hour and 10 minutes east, you'll find Lexington. If you ever watched the movie Secretariat or any of the famous horse race movies, this is that area of the country. They are breeding these horses there. You have jumbo jets from the Middle East flying into this airport they're literally sultans from the Middle East that are flying in to buy and sell their racehorses. Georgetown is right there. Okay, so when I popped up earlier, those estates, this is literally that area. And if you scroll around and look at it, 2.5 million, 3.5 million, 4 million. This is real life all around this building right here. So we're really excited about Kentucky because of all the jobs, the business friendly, and then probably last but not least, it's so landlord friendly for us. They actually give us fair eviction laws. We don't have anything that's limiting the amount of rent that we can collect. We can grow this portfolio as much as we want, just being good, fair business leaders. And we don't have the government breathing down our neck saying, hey, you can't do that. They're letting us do what we need to do to maintain the properties.
It makes for the perfect place to invest. We're seeing really strong returns across the board. We're actually ahead of schedule on our other properties. This one is going to perform really strong as well. If you're interested in booking a call with us, if you'd like to learn how you can invest in this property, what the tax benefits would be to you, how you can do a IRA or a 401k rollover, Sue, if we can make sure that link is in the chat, you can click that link. It will book on my calendar or on Sue's calendar. We're both highly qualified to talk to you about these. If you have questions about the deal, you can put those in the chat. We're going to go through some of the questions that commonly come up and just answer these. We can answer anything you guys put in the chat. We'd be happy to hear from you. If you are watching this online, if you put the question underneath the video, we will come back and we will answer those for you. Okay, one of the first questions that we get all the time is, how fast can I see a return on this? Nate, I know we kind of laid a wide piece here between 3 and 7 years. What should people expect?
Yeah, we want to underpromise and overdeliver. If you're looking for like a really short-term thing, like if you're like, oh my goodness, I need my money back in a year, this wouldn't be the right investment for you. It's not that we don't like you, it's that we just want to make sure that we bring this property to the level that it needs to be in order to hit the return expectations. 3 years is probably realistic for us if everything goes right and the economy goes right, all that kind of stuff. 5 years is kind of the average point where we're telling people just plan on your money being planted. 7 years is probably the long side of the equation. For us as asset managers, it looks better for us if we can get the job done faster. We make more money. And if you're also wondering, like, how do you guys get paid? Like, I'm going to talk about that at the same time right now, because I think it's important that there's transparency on that. And it also affects timing. Number one, when we bring a property like this forward, we get paid sort of like a real estate agent or a real estate broker does. We get paid a little bit less than most brokers charge to list a property like this. So we get paid a fee right there. The second time that we get paid is that when we make sure that we deliver your preferred returns, you get that first from cash flow. You get 100% of the cash flow the first year, essentially. After that, after we start raising rents and we achieve your preferred return, then we're entitled to get some of the rent money too. The third way that we get paid, and this is why we're actually excited to do the deal, is that when we find an exit, when we're able to sell it, or we're able to find a liquidity event where you get all your money back plus your profit, that's when we get our big payday. That's why I do these deals. I know it's why Chris does these deals and Mike does these deals in addition to tax benefits, but we get excited about that. So the faster we can get to that, the better. We're not in this to drag out keeping money tied up for a long period of time. It doesn't do us any good. We want to get the money working so that we can move to the next deal and make our profit check on it. Hopefully that answers that question, Steve.
Nate, the second follow-up question to that I get quite a bit is, what is our exit plan for this? Are we going to sell the property? Are we going to refinance the property? What does that look like for investors?
Yeah, so you got to go into every single business plan with a plan A, a plan B, and a plan C. And I don't want to bore people to death with like all the contingencies and things like that. But here's the thing. Plan A, the easiest to talk about and project, is to sell the property. When we get to a certain value and we know that we can exit it, we sell it, everybody gets their money back, they get their profit, and then we get to celebrate. Plan B is probably my preference, but it's harder to pitch and understand in a group format like this. I'm going to do it at a high level though. Plan B, what you do is you increase the value of the property. And then if interest rates are reasonable, if they're favorable in our court, then what we do is we go back to the bank at the 3-year mark or the 4-year mark, and we say, hey, bank, our value of the property has gone up a lot. Will you refinance this? Will you put a new loan on it? And then will you give us enough money so that we can give all of our investors back their money, plus give them a nice chunk of profit? And then we're going to keep the property. And if the bank's willing to do that because of the new valuation, that is the dream scenario, because everybody gets their money back at that point, and then we get to keep cash flow for life. If that happens, by the way, we're not like some of the other guys that are out there. Some of the other guys, if they do that event, it's called a refinance. Some of the other guys on a refinance, they kick their investor partners out. We don't do that. We have our investor partners for the life of the asset. So if you come in this deal with us and we happen to take plan B and we get a refinance to get you your money back, you would be riding with us forever, still getting distributions from the property. So that's at least from a high level explanation of what 2 likely events could be on the property.
I love that. And the key there is it's a small number of properties that you actually can do the refinance piece with, but it has to do with how much you can raise rents and keep that and multiply the building so that the bank will finance it at a rate that we can keep it. This is no one knows for sure. It's not crystal ball talk. But this property has a good chance, good potential when it comes to that. And we'll know down the road. Like Nate said, we are not like the other guys out there that would kick you out of the deal. If this deal works like that, then we're going to keep you in, which is an awesome benefit for you. I want to now go over to Chris. One of the questions that we get a lot on tax benefits is, have you done the cost segregation study yet? Which usually don't do till after you close. Do we have a preliminary one out there? Do we have an idea of what people can expect in tax benefit here? And then I have a follow-up to that one as well.
Absolutely, glad you asked. So that's a great question. We did get some preliminary estimates on this property. That's why I said we would expect a 30 to 40% based on your investments. We're coming in right at 35 or 34.5% initially, but understand that's the initial, quick pass, blah, 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 blah. We always drill down and work with the cost seg engineers to make sure that we get the maximum amount. But we're comfortable at this point saying 30 to 40% because we're falling right in the middle of that. So set that expectation, and then when we exceed it, you'll be that much happier with us, because I've never had anybody mad at me for giving them more than they thought they had coming.
Especially when it's a refund against your taxes. So Chris, just to put that into perspective, $100,000 investment, are they going to see 35% back this year?
First year, absolutely. That's what they'll see on their K1 as a quote unquote paper loss or a depreciation loss that they can take right to their accountant to get taken off, check off of their income so that they can benefit from the tax credit.
Pretty awesome stuff right there. Last question that I have kind of around taxes. Nate, go ahead.
If I could just put a little wrapper on that. So if you're like, oh gosh, what on earth does that mean? Tax credit? Just book a quick call with us. We'll walk you through it. And most importantly, a lot of CPAs don't even understand it. I mean, the tax code 7,000 pages thick. I've geeked out and gone through a lot of it, but most CPAs don't go through all of it, especially the nitty gritty. There are some things that you need to do to make sure you qualify for it. We're happy to help you. And if for some reason your CPA can't, we'll get you with one of our CPAs so that you can qualify. Just make sure that you don't do it the wrong way. We want to make sure you get set up the right way.
Absolutely. Chris, second question, kind of having to do with taxes. When we pay out quarterly dividends, are they going to be taxed on that?
I am so glad you asked that question because it's completely slipped my mind. So one of the tax strategies that we utilize is we don't pay dividends. You get the cash equivalent of your dividends. So let's say just for round numbers, you invested $1 million. So the return on that is $60,000 at 6% or $15,000 a quarter. So instead of paying you a $15,000 dividend payment, what we actually do is keep your dividends in the deal and we give you back $15,000 of your initial capital contribution. So a return of capital is not a taxable event. So your taxable stuff stays in the deal and we keep it in the deal till the end, where at that point you can either take the capital gains tax at 20% rather than your current tax bracket, or if you'd like to, roll it 1031 roll it into another deal so you don't get taxed on it at all. So that's one of the strategies that we use to keep your tax bills at the lowest possible numbers and provide the maximum benefit to our investors.
Awesome. That, just so you guys understand, that means that all your tax comes at the end, and if you 1031 exchange it, you will pay 0 tax on the money that you make with this deal. We're one of the few syndicators that we know that puts the deal together that way, and we do it because it is maximum benefit for you, the investor. It actually takes a little bit more time, energy, and money on our part to do that, but we want to give you guys everything that we possibly can. Home Invest is a Christian company. Everybody here is a believer, and our company is built on the Matthew 25 principle, which is that of being a great steward. And we want to help you be great stewards. We want to help you reach retirement faster. We want to help you grow that money as much as we can. And that is our mission. And this is one of the ways that we live that out. All right, Mike, you get the hardball question here. The people that I have sent this to, one of the first questions that comes up is, wait, these are all 1-bedroom apartments.
Mm-hmm.
What if they want a 2-bed? And there are a couple different answers to this question. One, we're on a waiting list. 2, it's fully rented. But Mike, like 1-bedrooms, how is this going to affect investors? How does this affect the property?
Yeah, so the first thing you look at when you find a property that's all one offer, whether it's be all studios, all 1-bedrooms, all 2s, or a mixture thereof, you look at 2 things. You look at how much, where's the occupancy? Since we're at 100%, there's a second layer question you go to. What percentage of units in Georgetown are 1-bedroom? Meaning, do we have is it a lot of places with not a lot of families are living? So we start to ask data-driven questions of the area. And then of the percentage of 1-bedroom apartments in Georgetown, what are they getting for rent? And what percentage of those 1-bedrooms are rented? So the average of Georgetown, Kentucky, the average rent per 1-bedroom is $1,033, $1,032. So, which by the way, we're getting about $745, $750 on average. That tells you we're like $280 low. That's what I mean by $2 to $2.5 million of lowered value just at market rent. So then when you're that occupied, but you're that low in rent, you're like, okay, Mike, but if it's 100% occupied, is that just because our rents are down low? You know, is that not, if the rents go to market, will we go down to 85% occupancy? It's a really great question. 95.5% of the 1-bedroom apartments in Georgetown are rented right now. 95.5%. That means there's essentially no living available in the 1-bedroom zone in Georgetown. So apparently these things rent. Now, why that is, I could speculate that maybe families go into Lexington because there's more to do. I could do all kinds of speculation, but the truth is just the data. The 1-bedrooms are renting on average at $1,032, and there's a 95, I believe it's 0.4% occupancy of those 1-bedrooms in Georgetown, Kentucky. So when you go, is having all 1-bedrooms an issue? Just so you know, 1-bedroom apartments are the majority of most apartment complexes. A lot of people don't know that. They assume it's just a mixture, especially in Lexington. A lot of our apartments, yes, we have some 2s and 3s, but you still have, at 130 units, you might have over half of them are 1-bedrooms. That's just the way it's built for apartment living. Because when people start to get bigger families, they go rent houses and that kind of stuff. They don't tend to go towards apartments. So most apartments, you're going to see a larger percentage of 1-bedroom anyway. When they're all that way, then you go start asking some market questions. Does the market just have, is it a lot of single people? Are those rented? And we've checked those boxes in the Georgetown area.
Awesome. There's a follow-up question, Mike, and it has to do with why is this place so far under rented? And it actually has a really unique story with the sellers. This is not your typical multifamily owners. Do you mind shedding a little bit of light on why this is 100% rented and it has been for a while? And how, like, some people that I've talked to said, well, I'm scared if you go in and raise rents, isn't everybody just going to leave and find something else? Are they going to be upset? Are we going to end up with negative reviews? There's a really unique situation with this, which benefits us in a huge way.
Yeah. So first of all, the owner is in his early 60s, late 50s. He's probably right around that 60 range. He's just ready to kind of retire. He's had the property for quite a few years, I believe 7 or 8 years. So he's been raising rents. His family manages it. His family owns a management company in town. So it's kind of managed by his own family. So it's a very small operation, mom and pop. And as he's continued to grow, he's just found it so much less stressful to push rents and have a couple, 3, 4 units vacant where you have to turn and do the work. We're just having 100% of his money all the time. We see that is a massive, had he pushed rents, he'd be selling this property for $9.5 million, not 7.75. And so that's to our benefit, but a lot of it just has to do with the philosophy of ownership, I would say. The philosophy of him was just keep it 100% occupied, $700-800 in rent. I continue to see Northeast and I'm good to go. When he bought it, they were probably at $400 or $500 a unit. Maybe less, I mean, back 7-8 years ago, they might've been right at that 400, 450. And so he's probably almost doubled the property in value since he bought it. And so it was a great investment for him. And this is the power of that win-win, but he really just has had the philosophy more of 100% occupancy over rent push.
Yeah, that's the very first building that I bought, that 8 unit. It was the same way. The guy had owned it for a long time. He really liked having 100% occupancy, not having to worry about it. And he had never upped rent. And it's a really easy way to go in and see results.
Yeah. Great point, Steve.
So we've covered this deal inside and out. If you have any questions, you can put them in the chat. Nate, I kind of want to circle back to you. Just like, you've seen a lot of deals, you've done more underwriting. I think everybody here, Mike, I know you've done a ton, but Nate, you love spreadsheets, you love digging in, you love going through all the numbers here. Is there anything that you saw either in the rent rolls or the T12s? Is there anything in there that investors need to know about?
Yeah, there is. And it's actually, I'm going to go external data on this that you should know is what the market players are doing right now. Blackstone, who is the largest player in the space, they've got more real estate than anybody else in the country right now. They just said, John Gray, their head of real estate, they just said that he thinks that prices have bottomed in multifamily specifically. He's not talking about single family. I know if you're like, Nate, single families haven't gone down yet. I know, but for multifamily, they have. Multifamily, they didn't have any kind of government protection from these interest rates that kept going up. They didn't have any government bailouts or anything like that. Single family has its own like propping up going on, but multifamily didn't. When offices started going down, multifamily started going down, and that started at the end of last year. I'll show you the graph if you want to see it. Multifamily, by the way, it's only gone down in price like this twice in the last 30 years. This is not a normal thing. Like if you're waiting for your window, pay attention to this part. In 2009, multifamily went down. It had a dip. And then at the very end of last year, it went down. We're currently in the dip. How long will the dip last? I don't know that answer. That's crystal ball talk, but I'll tell you right now, John Gray from Blackstone, they just authorized $20 billion in the last quarter of buying multifamily property. They are going like pedal to the metal as fast as they possibly can, gobbling up multifamily property. And so when I look at graphs like this and data like this, and I see the biggest player in the industry doing it, and I see that we can cash flow year number 1 to make our investors whole and make us happy, I get excited. So that's, I think, an important fact that we need to have on the table.
I would agree. This property knocks it out of the park across the line for all of us here. I believe we have answered all of the questions and we're coming close to the top of the hour. I kind of want to open this up. I think we'll do like a round robin. Nate, you just gave a great summary as to why this is such a great time and why this property is so strong. Chris, any closing comments?
If you're going to grab a deal, this is the one to grab. If this is your first time investing, this is one of the best opportunities that you're going to see this year, for sure.
I would agree. Mike, I know you've been really active in the area. I know you've seen a lot of things going on there. I know you're talking about manufacturing. Why this deal?
Yeah, so if you talk amongst the Lexington, like the country club boys, like, hey, where should money flow right now? Georgetown is probably one of the hottest submarkets within 100 miles of Lexington. And Lexington and Louisville, Kentucky are some of the top investment markets right now in the country. And I have learned personally, location can turn an okay property into a great property, and it can turn a great property into a terrible property. Your location is your greatest driver. And right now we're next to jobs and we're next to growth. And Georgetown is 30% below the national average of rent per square foot, meaning it's affordable. That's why people are moving there. That's why you see a lot of migration there, even outside of Lexington. Lexington's more expensive, so people are moving 15 miles outside of Lexington and driving into work. So it's a market that's leveraging low cost of living as of now, and we're on the bottom end of that, right? And so that's why I love this area is the biggest driver, in my opinion. And it's not just Kentucky, it's not just Lexington, it's this town specifically.
I would agree. And they're not making any more buildings there, and there's not much. You worked a long time to bring this deal to the table. I think it's one of the reasons that it subscribed so quickly. So again, if you are interested in investing with us, you can click the link that is in the chat. You can book a call with myself or with Sue. We'd be happy to talk to you. If you want to roll over 401k or an IRA into this, you definitely can. Chris touched on 1031 exchanges. This is a very friendly 1031 exchange property. We are fully verbally committed right now, but we are going to be taking some backups. Usually there's room for 1 or 2 people to jump into the deal. So if you would have questions, if you'd like to talk about this, you can click the link and book in the chat. With that being said, though, we are going to go ahead and wrap this up. It's been great hanging out with all of you. If you have any questions that you want to reach out to us, feel free to email them. You can respond to any of the emails that you've got or any of the texts. The question, is this accredited or non-accredited? This is accredited. This is meant for accredited investors. If you are a non-accredited investor, please reach out to Sue or I. We do have non-accredited investments coming up that we'll be able to talk to you about within the next 30 to 60 days. But this specific deal is for accredited investors. That means that you make over $200,000 a year singly, $300,000 a year jointly, or you have over $1 million in net worth, not including your primary residence. All right, Nate, anything?
Yeah, two quick things for anyone that's following online right now. If you're looking for a link and you're like, where's the link? Just type in the chat section, just type call, 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 and then we'll reach out to you. We'll get you set up with a 15-minute phone call. And then Steve, if it's okay, I'm just going to share this on the exit. This will be kind of the closing remarks. Those of you that want to see the property physically, this will probably be the next best thing. We do have an investor of ours that's going to be there this Saturday. We'll show you a quick
Pine
video.
Tree Path, as you can see there, is the path that it was named after, obviously. But these buildings, there's 9 of them that I'm on here doing inspections today with our Hope Homes Inspections, Paul Hope. And these are some pretty cool. I'll give you a quick tour. So here are 3 of the buildings that actually have under the building carport parking, which would definitely be a nice premium for people that want that. And these 3 buildings are pretty cool.
So I'll cut it off there, but for anyone that wants the full version, or if you want to see the hundreds of pictures that we have or any of our underwriting, you're welcome to it. We're happy to get it to you. Just quickly book a call with the team and we'll slide that over to you. That's all I got, Mr. Steve.
All right. Thank you all for tuning in. Again, if you have any questions, anything that we did not answer here that you want to ask us personally, you can book a call with myself or Sue. You can also respond to any of the text messages or emails that you have received. We'll be happy to get you an answer. Wishing you guys all an amazing Thursday, and we'll talk to you soon.
Guys.